I said, the premium growth is definitely there, no question. It's amazing some of the premium quotes I've been hearing from peers in the industry. It's not going to mean that it won't constantly be under the light of scrutiny based on, I would say more or less, I think there's going to be a sharp eye on how these claims are handled and the validity of the declinations of claims. I think it's going to be critical because if folks are submitting claims for what's perceived to be a legitimate breach, attack, or loss event, and the declination rate on these, if they start to rise, you're going to get more and more folks rethinking cyber insurance as a risk transference option.
Hello, everyone, and welcome to today's session. This is Jeannie Jessica, and you're listening to Secure Insights, a series of conversation with industry experts, influencers, and leaders in the cybersecurity space. On popular demand, we have come up with second part of the Cyber Insurance podcast with Jim Rutt, the Chief Information Officer of Dara Foundation. And as I mentioned in the previous podcast, today Jim will address more questions on cyber insurance. In our last podcast with you, Jim, we got to know from you that what types of cyber risks are insurable. So now we want to know that in what situations does cyber insurance not cover you?
Yes. Oh, thanks again for having me back. First of all, Jeannie, it's been a pleasure. I think one of the key areas that you have to be careful in terms of expecting any kind of claim coverage is the way an attack might be classified from a macro level. Now, what that means is you may be attacked individually as a company or an individual, but if this attack is classified as a larger approach, in terms of a nation state. So, I would say if it's classified as a act of war, many policies, and cyber is amongst one of them, have exclusions specifically for attacks or state of war exclusions in their underwritten policy. We saw a couple of examples of this. I won't name specific parties, but in cases where a claim was attempted against a cyber insurance policy, but it was part of a larger nation state attack, so the underwriter and the reinsurer was invoking the act of war exclusion to stop the fulfillment of the claim. So this is always something that is in the back of your mind, no matter what kind of insurance. Any kind of corporate or industrial insurance will have this, but there has to be other risk mitigation factors in play in your overall risk management strategy. I think cyber insurance is not the only piece of the puzzle. Again, as I spoke about last time, the primary use of cyber insurance is for risk transference, for that part of risk which you feel the acquisition of controls or implementation of processes won't mitigate. It can also, as much as it can help transferring that type of risk, it's not a be-all, end-all. And the other thing to think about is, while a nation-state attack against a private enterprise might be rare, there have been precedents to this. So I think it's just a matter of understanding your systems, once again, going back to understanding the valuation of the assets and the classifications thereof, and realizing that you may have to have some contingencies in terms of mitigating controls for that in case you attempt to bring a claim in the event of some kind of an attack and it gets classified as a act of war. So it's always something in your back of your mind that you want to keep in touch. That's the major area that cyber really doesn't cover. I think there are other policies that have been around for a long time that are peripheral. The one that comes to mind is errors and omissions, or E&O. Some of these have had computer crime elements to the underwriting coverages, but you want to be very careful that you don't have any kind of impedance mismatch between those. Those are kind of two key areas. In most cases, as I stated before, a lot of the reasons why you would use any kind of coverage or attempt to make a claim are not only technical, they would be peripheral, like legal coverage, PR coverage, brand protection coverage, et cetera, even credit agency monitoring, et cetera. So.
All right. So, will my cyber insurance protect me if an employee caused the attack?
Typically, yes. I mean, this is a corporate policy in most cases. Now, prior to underwriting any of these policies, typically what's asked for on the application are key stakeholders within your organization that may have uh, access to classified or sensitive data, or data that could be affected by some other regulatory encumbrance. Uh, that would probably inform the actuarial calculation of the premiums that are applied to you. These are all factors that are involved. But typically, yes, I think, there is a typically, as I said before, there is historical precedent for errors and omissions coverage in other areas of corporate type insurance, which it's assumed that usually a staff member would would trigger the applicability of the claim. So yes, I mean the answer is in most cases, with very few exceptions, those kinds of coverages will come into effect for an employee.
How do we quantify cyber risk in financial terms? I mean, can we do that?
We certainly can. Now, is it an exact science? No, but we can get very close. So there are two overarching areas of risk calculation. One is qualitative and one is quantitative. So qualitative is more of a gut feel type of thing rather than a actual arithmetic computation of risk or financial computation of risk. It's understanding a lot of soft factors in your business and figuring where risks could come up as a result of where you sit in your industry or what the type of business that you may do, or the folks you do business with, or your supplier uh, uh, ecosystem, or some of those other areas. But in terms of the other major type of risk, which is quantitative risk, there are a number of different frameworks, I will call them, that can be used to calculate with some degree of certainty financial loss or loss in terms of dollars in case of a breach or similar attack. Now, again, are they exact? I don't think we can ever get exact, but we can get very close depending on our understanding of what we are charged with protecting and what we are charged with mitigating risk against. So typically, in terms of quantitative risk analysis, there's a very basic formula, and a lot of frameworks build off of this formula, where you take you kind of quantify the types of threats against, or first of all, you take like a replacement cost of an asset, right? So risk management is typically done by the assets that you're charged with protecting. So you would figure out the replacement cost of an asset should it be compromised or made rendered inoperable. You then calculate in numerical terms the perceived threats against those, and there's many models out there that can help you to come up with that number. And then essentially it's a multiplication. So you take the value of the asset that you're trying to protect. You're trying to multiply that by some perceived threat factor, and then multiply that by yet another factor, which is tied to how vulnerable that asset is to attack. And again, there are a number of different models like FAIR, factor analysis of information security risk, NIST, National Institute of Standards and Technologies, that can help you come up with some of these other factors to build a mathematical model of risk from a quantitative perspective. Not only risk, but take understanding once you have that risk, what residual risk you would have after you apply different controls and different mitigating factors, of which cyber insurance is one of them. So that can certainly help to build a cost benefit analysis of cyber insurance in and of itself. If you're spending way more in cyber insurance premiums than it would cost to replace your asset, it may not make sense. Therefore, obviously, I think risk calculation, risk management, this is absolutely a precursor to understanding if you even need cyber insurance at all.
Can also cyber risk modeling be flawed?
Certainly. And I think it's still evolving. I wouldn't, flawed is kind of a strong term. I think it's more an understanding. I think because the nature of attacks are changing rapidly, week by week, month by month, and the different methods of attack vectors into an organization are changing. The good news is that controls, at least the commercially available defensive, mitigating, compensating technical controls, are constantly evolving. We've seen a lot of great innovation in the technology used there. It certainly helps and informs the risk modeling process. But the old adage applies: we don't know what we don't know. And 2 or 3 years from now, there might be even more pernicious types of attack vectors into our environment. And the other thing is, I think more of these attacks are shifting towards a psychological or end user based kind of focus as opposed to strictly technical. And as our types of communications between our internally, outside with other vendors, outside of other partners, relationships, they become more and more of a trust-based scenario. Attackers or bad actors are learning more and more how to get that first step into an organization, and then be able to trigger the appropriate technical controls. So these types of attacks are becoming multi-edged, multi-factor, multi-sided. So it's very difficult to be able to see into the future. Yet then again, we know what we have today. We know the types of attacks more or less that are happening today. We can kind of use as baseline to extrapolate into the future and see what we need to protect in moving forward. But it's going to be constantly evolving.
Jim, how big is the cyber insurance market?
It's more and more folks are getting into it. It seems it's definitely a multi-billion-dollar industry. The other thing that kind of colors that assessment is you've got some of the major underwriters getting into this. In terms of premium growth, obviously, I think I had mentioned this on the last podcast, but we've seen a major growth over the last 2 years, and I think it's completely due to the amount of attacks and the amount of risk that needs to be covered. The growth of the industry is definitely going to move in double-digit percentages, I think, for the next couple of years, countered by some kind of premium ceiling at some point, because many discussions happening out there are coming back to that cost benefit analysis that I was talking about previously, which is how much is too much, and how much are we going to be spending on this coverage, and are we really going to get the perceived benefit out of it should a claim be necessary, and is it really covering that amount of risk in a diligent manner that we could not use a mitigating or a defensive technical control, or somehow change, if it's that serious, re-look at how our business processes that are peripheral to that event or asset and see if we need to change something fundamentally in order to reduce risk.
As mentioned by you, that the growth of this industry will move to double digit percentage in upcoming years, and also that many underwriters are getting into this domain. So can we say that the future of cyber insurance is quite bright?
If you're an underwriter, sure. Like I said, the premium growth is definitely there, no question. It's amazing some of the premium quotes I've been hearing from peers in the industry. Uh, it's not going to mean that it won't constantly be under the light of scrutiny based on, I would say more or less, I think there's going to be a sharp eye on how these claims are handled and the and the validity of the declinations of claims. I think it's going to be critical because if folks are submitting claims for what's perceived to be a legitimate breach, attack, or loss event, and the declination rate on these, if they start to rise, you're going to get more and more folks rethinking cyber insurance as a risk transference option overall. And I think it's going to shift back to, like I said, using other areas of risk mitigation and risk reduction to fill that gap. I mean, the one good thing that cyber insurance is that it's kind of easy. You underwrite it and you have some understanding that it will cover most of your residual risk. But I think we're in the early stages of the game, and I think we need a lot more history to inform us if long term this is going to be the way to go. We're still, I talked about also um, the evolving of these types of attacks and how different it's going to be as our private networks change, as we've moved more from an on-premise situation to more of a hybridized and remote work situation. And there are risks that we still haven't really thought about as we become more mobile, as the application we use are more de-abstracted from a traditional internal network situation. So it'll evolve, I think, in lockstep with a lot of these elements. So it's going to be an interesting journey, nonetheless, to watch.
So, guys, we have come to an end of this series of cyber insurance, everything you need to know. A big thank you to Jim for coming and joining us. And also, thank you, listeners, for tuning in to Secure Insights. We will meet again on our next episode. Until then, goodbye and stay safe.